Welcome to PocketExperts.Solutions. This event is for educational purposes. The terms and conditions and the privacy policy apply as posted on the PocketExperts.Solutions website. Today, our guest expert is Chris Hamilton. Welcome, Chris.
Thank you, Mark.
Chris is a certified public accountant, certified fraud examiner, a certified valuation analyst specializing in fraud and forensic accounting in the context of complex civil and criminal litigation. He has served as an expert witness in civil, criminal, probate, and family court matters. His accounting and consulting firm is located in Simi Valley, California, and he's regularly retained to lead forensic investigations of fraud, embezzlement, and asset misappropriation. Chris has made presentations across the country and the nation at national conferences, training institutes, and seminars on topics including valuation, damages, fraud detection and prevention, forensic accounting. He is an instructor on the Forensic Accounting Academy across the country. Chris has published articles in several periodicals, including the Forensic Examiner, Los Angeles Lawyer, the Valuation Examiner, Valuation Strategies, and the Journal of Forensic Accounting. He currently serves on the editorial board of Insights on Valuation. He is a co-author of an advanced finance and economics textbook, Financial Valuations, Applications, and Models. We're going to talk a little bit about today on how we can maximize the value of business. Let's take a look here as we start looking at value drivers. Why don't we start the conversation with, what are value drivers and how do they become two of the majors?
Yeah, this is a fun topic. I'm looking forward to this conversation today because the goal of any business owner, I would imagine, is in some form or fashion to increase the value of their business. And a lot of business owners would say, my goal is to increase profit or increase my take home. And that's all wrapped up in the same discussion. And so I'm assuming that who I'm talking to today are people that own businesses, and you're wanting to know how to increase the value of your business, whether it's to sell it or just to be more successful. And I think what you're going to get today is very, very helpful. And I'm going to talk about it in the context here initially of if you wanted to sell your business, how do you get it ready for sale? And before I jump into the major drivers of value, I want to put it in the terms of an example that I think most everyone can relate to. If you've ever owned a home and wanted to sell it, you call a real estate agent, have them come over, maybe you know the agent, and if they're honest with you and you ask the question, they will point out in your home what you need to do to make it more attractive, to help sell it faster, but also to increase the value of the house. And, the latest thinking is pour your money into the kitchen and the bathrooms, believe it or not. And that's what is most dramatically evident to people who want to buy homes. And, water the lawn, fertilize it, trim the flowers around the front, and it just makes your home more attractive. That's what we're talking about today. And there's two major drivers of business value. They are income and risk, and I'm going to explain those to you. When somebody buys a business, what they're buying, and not even just a business, let's just talk about a stock. If you're going to buy a stock in the stock market, you're buying based on two elements. One is you want to know what is the income that stock is going to provide you in the future, both in cash flow and in increased value of the stock. And the second thing you're going to consider is what is the risk of this stock, of that income. And it is the same thing for a small, closely held business. That if you own a business and you think you're going to sell it someday, the buyer's going to come in and they're going to want to know two things. They're going to want to know what is the income that this business is going to produce for me in my pocket, and what is the risk or the probability of that income actually happening. So When I say the two drivers of value are income and risk, basically the math comes down to this. A buyer is going to figure out what is the annual income this business will produce, and they're going to divide it by a risk rate. And the risk rate reflects all of the risks associated with your business. And so $100,000 annual benefit stream over and above salaries and expenses and taxes, there's going to be $100,000 left. If that's the number, the way you value that benefit stream into the future is you divide it by a risk rate, also known as a capitalization rate, which is also known as a multiple. But that 100,000 divided by that risk rate, let's say 20%, gives you a value of 500,000, and that's what they're willing to pay for that benefit stream. Obviously, they're getting more than the cash flow. They're getting the business, but they're getting the opportunity to take that business and grow it. So that income is ultimately cash flow. Cash is king. The risk is the probability of that income. It's also an expected return. So someone who's going to invest in a small, closely held business has a rate of return that they expect to get to compensate them for the risk of the investment. And that's another way to describe that risk rate. And it's also an opportunity cost, that somebody who's buying a business is going to consider other businesses maybe at the same time, or they've already considered alternative investments and they have made a decision that they want to invest in a risky asset. And the thing to remember is small, closely held businesses are higher risk than public company stocks. And so it's a unique marketplace. It's a unique arena for buyers and sellers. In some cases, they're looking for a paycheck, meaning the buyer. And maybe that's why you might be considering buying a business. Or if you're selling a business, that may be what the buyer is looking for. But if you're in the marketplace looking for a business, you're not just looking for a paycheck. You're looking for maybe a job, but you're looking for a return on your investment. And the rate of return you expect to receive on your investment drives what you're willing to pay for that business.
Hey, Chris, we talked a little bit about how the capitalization rate and the multiple are the same. Can you give us a little example on how you would utilize a capitalization rate and how you would calculate that value versus that of a multiple? Are they the same or are they different?
They are the same number, but they're applied differently. It's a good question. So if you find out, if you're selling a business and someone comes in and says, I'm willing to pay 5 times earnings, what that means is obviously that you take your earnings times that multiple, and that's the price they're willing to pay. That is the equivalent of them telling you, without telling you, that their cap rate is 20%. The risk rate that they're using is 20%. And the way you convert that is a multiple of 5 divided by 1 is 20%, or 1/5 equals 20%. Going back the other way, 1 divided by 0.2 equals 5. And the math works later on when you are sitting in front of a calculator. You can do that math and see that a multiple of 5 is the same as a cap rate of 20%, and a cap rate of 20% is the same as a multiple of 5. So income divided by a cap rate, let me use numbers, 100,000 divided by 0.2 is 500,000, and that 0.2, it converts to a multiple of 5, so 100,000 times 5 is that same 500,000. So that's how those work. So in some places you'll hear people talk about cap rates, other places people are talking about multiples. Those are the same numbers, they're just applying it differently to the income stream.
Outstanding. Let's take a look at the next question here. What steps should I take to increase the value of my business? There are certain things that we can do that helps if we have an understanding of what to do to generate value that is exponential to what our cost of obtaining that value. Can you kind of give us some insight as to what steps they need to take?
Yes, and to go back, this plays right off of what we just talked about. If there's two drivers of value, then there's really only two ways to increase the value of your business. And so if the two value drivers are income and risk, then it naturally follows that the two things you need to be concerned about in increasing the value of your business are income and risk. So let's deal with income first. Obviously, if you increase the profitability of your business, it probably makes total sense to you that you are increasing the value of your business. And it sounds logical, and it's true. So sometimes you cannot increase sales, but you can get more efficient in expenses. And you start cutting away, and this is a process that a lot of sellers go through. They begin to cut away overhead and other non-essential expenses. And that's a hard process because nobody really believes they have non-essential expenses. But when you're getting a business ready to sell, that is one way to increase the value of your business, is to demonstrate that your business is more profitable. On the risk side, if the risk associated with your business needs to be reduced, that's the bottom line. And let me explain that. If you have a multiple of 5, that reflects a risk rate of 20%. It probably makes sense to you, if you don't do this all the time, that the higher the risk, the less the value in the business. And that is absolutely true. So if you have a multiple of 5, your business is worth $500,000 and you think that's what it's worth, and someone comes in and looks at your business and they say, you know what, we're only willing to pay 4 times earnings. We're going to offer you $400,000. What they're telling you is that your business to them is more risky than you perceive it, or it's more risky than the average business in your industry. And so what you want to do is position your business such that you are minimizing the risks. And I want to talk specifically about what goes into that multiple. That multiple is a reflection of 2 kinds of risk. There's the marketplace risk. It's the risk that every business in the U.S. economy faces, things that we have no control over. There's nothing you can do about that. You cannot minimize that risk. The risk you do have control over is called unsystematic risk. Those are risks that are managed and driven internally in your company uniquely as compared to any other business. What we're talking about there is depth of management, quality of management, positioning with competition. So, for example, if you wanted to reduce the risk of the company as it relates to competition, you start to make management decisions to give your company some competitive advantages that lowers the risk of future revenue. One of the practical ways is maybe you cut the price of a product to prevent competition, or to give the business an edge over competition. There's market share and positioning of the company in the industry. There's certain things you can do marketing wise, or sales mix, that kind of thing, to position the business so that the perceived risk in the industry is reduced. There's financial strength, and this goes back to adjustments to income and expenses, where the stronger the balance sheet, for example, retaining some cash in the business so that the balance sheet looks stronger. Stability, if you have high employee turnover, that maybe you start addressing that issue so that employee turnover is not as high of a risk. So those are just some of the ideas, and And I think you probably get the idea that you're dealing with business environment in your specific business that gives the appearance of being a risky business or a riskier business than your competitors or the industry. And there's things you can do to reduce that risk.
Chris, of the two major drivers, what do you think is the easiest way to affect the value most quickly? What can we do today to
Yeah.
help us maximize this value?
Yeah, it's kind of, yeah, it's akin to the real estate agent saying paint the front of your house and it'll sell faster. There's the easy one of the two. Remember, the two drivers of value are income and risk. There's two general categories of what can you do to increase the value of your business, increase income, reduce risk. The next step here is which one is easier of those two? It's the income. And businesses do this a lot where they will cut away administrative staff, they will cut administrative expenses, overhead, they will lean down the organization fairly quickly by doing that. You have to keep in mind as a business owner, though, and I know you know this, but I'm just going to state the obvious, that this is temporary. Management decisions made to cut costs, particularly people, to make the company more attractive, will make the company more attractive, but it's not sustainable long term. It puts a nice shine on the business. It looks like a new coat of paint, so to speak. But you know that in the long run, if you cut too deeply to prepare the business for sale, you can start to damage your business in the long run. You can't control sales, but you can control expenses, and that is the quickest move that business owners make to get it ready to go. The other thing is to clean up the income statement. So if there are unusual transactions or what we call non-operating transactions, you start to clean those out of the operations of the business. So if there's personal automobiles that the owners are paying for through the business, you stop doing that. If there are family members on the payroll that couldn't find the business with a map, you probably ought to get them off of the payroll. You know, things like that. Personal expenses being paid through the business. If there's anything like that going on, you want to stop doing that. And if you're paying a non-market rate for rent to an entity that's commonly owned, so if you own the building and the business is paying a non-market rate of interest, rent, you probably want to adjust that. You want to put contracts in place, for example, with related parties for rent. So those are the things you do that probably will benefit the cash flow in the business, but it also cleans up the business so that it is easier to sell. It's more marketable. And that's the other aspect here is you can have a fantastic business, but if you make it hard for a buyer to come in and understand what they're buying, it slows down the process of sale, and it also gives a buyer negotiating room to start grinding you down on the price.
Chris, I
So
think
of the
it's
two,
also,
income
I'm
is
sorry,
easy.
Chris, I
Yeah.
think it's also, there to note that when you're trying to maximize value, for every dollar that you can save and continue operations at its level, if the cap rate that we talked about earlier, the multiple was say 5, then for every dollar that you save that goes into that numerator or that cash flow stream is a value increase of 5 times. So if you save $100,000 worth of expenses that you can become more efficient on, you've increased the value of your entity by $500,000. So you can kind of see why this is so important and why cleaning up that information is so critical. Because when you're looking about selling the company, those little expenses that you're doing that you're really not aware of or trying to become more efficient so that you save 5 or 10% on those little things all add up. And for every dollar that you can save, when you think about generating $5 of value, that's a heck of a return. Chris?
Isn't that amazing?
Yeah.
Yeah, and that's what that it's so easy in one sense, and yeah, you leverage working on that income statement, and it really does pay off quickly.
Let's take a look at how long it takes to increase the value of my business long term. And I think that we just talked a little bit about the income side of being able to get those expenses. But then you have the other side with the risk, right? How is one
Yeah.
harder than the other? And what is the time that you can expect to see a return?
Well, and as Mark just detailed, you can make changes on the income statement, and it's going to translate very quickly to increased value, almost immediate. Risk, on the other hand, is much more difficult. Takes a long time, and sometimes a very long time. So let's say you evaluate the depth of management, and you realize as you approach retirement or the end of your career, and you're looking for what's going to happen with this business, it's good to think about the depth of management and the structure of management and who populates your management and what their skills are and what's going to be needed in the future. And you do that with a very long view. You don't get to just flip a switch and change management or restructure management generally without causing a lot of problems. So the concept there is that if you're looking at a 5 to 10 year window of selling the business, or even like a 2-year window, I don't want to make it sound too long, but when you have a longer horizon on a liquidating event of getting out of the business, of selling the business, that's where you address the risk factors. And you start thinking about management, you start thinking about position of the business in the industry, you think about maybe restructuring the balance sheet between debt and equity to make it appear stronger. All of those factors take a little bit longer time. So, you know, the income you can increase overnight almost. On the risk side, in other words, increasing that multiple that somebody's willing to pay, that is a concerted long-term effort that takes some wisdom and some patience and really a purpose. You pick your target and you go at it over a period of time.
Chris, do you think it's important then for the members to start thinking about developing a plan to enhance that risk profile over a period of time? And sometimes 10 years is not even, soon enough. I mean, if you're somewhere around 55 years old and you want to sell your business when you're about 65, that's the time you want to start understanding the risk profiles, and you really want to start developing and minimizing some of that risk, putting certain attributes in place so that risk profile, when the time comes to sell, is already there, right? And that's a little bit different than saying, I want to sell next year, and now what can I do with my risk profile? So ultimately, some of the planning that needs to take place, and some of this information needs to take place, and you need to put an action plan in place to really maximize your value. And that starts earlier, not later. Fair statement?
Absolutely. Oh yeah. Yeah. For example, just a quick example of, there's a firm, it's called Jones, Smith and Wayans, and they make a decision that, my goodness, we're all getting older. We're going to want to move on, but the identity of the firm is so tied to the three of us because our names are in the firm. So you go through a process of, well, let's rename the firm, re-image the firm based on the new name. Therefore, the business isn't tied to the persons; it's tied to the goodwill of the business. That's an example of what you're talking about, Mark. That doesn't happen in 6 months. That's going to be probably 6 months before you can agree on what the new name is. and then you're re-imaging the firm under the new name, so that when you want to sell the firm, nobody's concerned that there's personal identities identified with the firm. It has a separate identity, and it's much more saleable and actually has more value. So I agree. It's a great point.
There's so many of the clients that we see that love to keep control over their particular business. And just so that you're aware, if you're one of those people that loves to keep control and everything has to go through you, understand the fact that that's actually costing you value. Because God forbid, if you weren't there, how then does the company operate, right? So you're better off putting systems in place. The most valuable companies, the most valuable entities are the ones that can run without you. And that's just such a critical point, but it takes time to be able to put those systems in place. Chris?
Yeah, there's momentary satisfaction of and ego satisfaction of having your name attached to everything in the firm, but in the long run, I couldn't agree more. You're gutting the value of the firm, and it's hard to tell somebody that because they think the value of the firm is them. And if it is an individual, it's limited. If the value of the firm is based on the entire team and the product or the service that they produce, not just that one person produces, it probably makes sense to you when you think of it in those terms that that's going to be more valuable.
What do you think it costs as far as money to increase the value of your business?
Well, it will cost money. Some of the things you and I are talking about, Mark, of repositioning the firm in the marketplace, or refashioning management, maybe upgrading management. There's definitely a cost to that. And there's two costs. There's monetary costs, and then there's time. Because it's, with some exception, it's really hard to turn on a dime. And, for a small business owner to change their focus from making payroll in 2 weeks to building value 10 years from now, first of all, we'll talk about that's a lot of fun to do, but it is going to cost some money and maybe a reallocation of resources, including time. If you're addressing income issues, meaning net income issues, you're cutting costs. Obviously, there may not be a cost to that. There actually might be a cost savings to that, and but it does require kind of an untethering from the way we've always done it to a concerted effort to drive this business in a little bit different direction, which is building value, not just making payroll.
Right, and that's a huge difference, isn't it? Because there's so many companies, the only thing they're concerned about is what am I going to be able to afford this week? How am I going to make payroll this week? And it's such a negative drawdown on value by thinking so limited as to what am I going to do this week, that nothing ever changes from this week, right? And 10 years from now, you're doing exactly the same thing, trying to fill the same exact payroll as you're continuing to go forward. And that does not maximize value because you never put the plan in place to do some growth, to do something different that would then generate value long term. So it's a combination, in my opinion, Chris, to not only look at what it is that I have, but put a plan in place to where I want to go. And then how am I going to get there? And then how am I going to do a combination of reducing risk and increasing my cash flows or income? And both of those are all about maximizing value.
Mm-hmm. Yep.
What professionals will I need to hire? It's always a question that we look at towards the end of a presentation as we start dealing with some of those issues, because some are easier than others, right? And some you just don't want to mess with. So what are your views on hiring professionals, and how can they help you maximize?
Well, there's a slew of professionals that would love to take your money and help get you there. I think at the base level is, there's a number of types of professionals that can help you start thinking differently about your business. Pocket Experts is a very inexpensive set of professionals. You know, you're listening to this podcast. There's a number of other podcasts that you can access that will help you start changing your thinking and considering what is it about your business that you think you can change that will increase the value. And let's say it's the positioning of your business in the industry, rebranding, if you will. That's a marketing expert that can help you understand where your business is today and where it is you want to take it. You may have a perception of your business today and the risk associated with the income in your business today, but an outsider can come in and give you a perspective that's entirely different. And this all requires a measure of humility too, by the way. None of us who have built a business like to hear that it could be so much better, because the implication is it's not what it could be today. All of our businesses are not what they could be. And so it takes a bit of humility to acknowledge that and and actually pay someone to give us that bad news. And a marketing person is someone that can do that. A management person, you know, someone to help you consider your management and dispersing the command and control from you to a group of people. Ultimately, that's what makes your business more marketable, is that it's less dependent on you, the owner, and it's more dependent on several people so that the risk associated with management is dispersed. So, you know, attorneys, most small business owners I know don't like paying attorneys, but they are on your team. And there's a couple things you may want to talk to an attorney about if you're taking the long-term view and building value and getting a business ready to sell. One is protecting your patents and other intangible assets. If your business involves unique processes, recipes, or products, and you are not current in protecting those assets are not as saleable. And one of the ways to lower the risk of your business, increase the value of your business, is to shore all of that up. To the extent you have intangible assets, having an attorney review all of that and make sure that everything's current and protected. Also, an attorney can help you formalize or update your operating contracts. I mentioned this already: related party leases, compensation agreements, related party sales and production contracts. What hurts some small businesses is they have these relationships and oral contracts. You know, I always hear this business runs on handshakes. That's great, and that's what's gotten you here. But to get your business ready for the next level, to prepare to increase its value by lowering its risk, one of the things you need to do is convert those handshakes to contracts, written contracts that are transferable, that are understandable by a potential buyer. That's one maybe necessity, depending on your business, of hiring a professional. Another use for an attorney in preparation for the sale of a business and increasing the marketability of your firm is assisting with buying out non-control or problematic owners. I can't tell you how many times I've seen a transaction going down the tracks. Someone has worked hard on getting their cash flow up and their risk down, and they didn't address problems among the owners. And there are problematic owners who will be problematic sellers, and they can blow up the deal just to blow up the deal. It's better to deal with all of that before you're anticipating a transaction. And that might take a year or two to work out, but that is something to consider when you're trying to increase the value of your business and make it more marketable for whatever reason. Plus, it would simplify your life, I suspect, just getting rid of problematic owners. On the financial side, if you have an outside CPA or other financial professionals that you already have a relationship with, they can help you, sit down with you and do projections. help think through how to increase cash flow. They can bring an expertise to the table. They're experts in finance and you're the expert in your business. You can leverage that relationship to do some projections, clean up your accounting. Again, when a buyer can come in and easily tell from your financial records what the business does and how profitable it is, your business is much more marketable. And then ultimately, a valuation expert, someone who can come in and tell you what your business would probably sell for today. And in that process, you know, Mark and I do this kind of work. We could talk about this for quite a while. In the process of valuing a business, you figure out areas where obvious low-hanging fruit, where the value of this business could be increased with a little bit of effort, or you know, doing an effort benefit analysis in this area or that, almost right away could increase the value of the business. So a valuation expert could be very helpful. So there's a list of professionals that could help in the process of increasing the value of a business.
Chris, what do you think some of the other problems are associated with the effort to maximize the value of the business?
Well, the problems I've seen is when it's really a 3-year project and the business owner wants to pick the low-hanging fruit right now. So the business owner goes through and cuts half the administrative staff. And immediately there's fantastic profitability, but the business can't be sustained with half of the administrative staff. And so the wheels start coming off a little bit. It can start to affect morale. And in the mid to long term can affect financial results. So if the sale process takes a long time, midway through the sale process, the buyers are seeing a business that's in some level of distress, and it isn't really, but it appears that way because the clippers were taken out too soon and the tree was pruned, if you know what I mean. So,
well, Chris, I mean, even as you were talking, and I'm sorry I interrupted, but as you were continuing that process down, when you think about cutting 5 administrative staff, it sounds horrible, and then you come back and you say, well, that really isn't really functional. You can't continue that on. But I think long term, if you had an efficiency expert really in place, one of the things that happens in small, closely held companies is people have been there for a very long time, right? And they continue to do the work and they continue to do something. And then you add another person, and then you add another person. Why? Because maybe technology has come around and the other individuals are getting older, but they've been there for so long, you really don't want to let them go. So you just add somebody else and add somebody else. And before you know it, 15 years later, you have a bloated staff that is generating, you know, cash flow drains of $100,000, $200,000. Well, when you start thinking about that multiple again, if you had a $200,000 drain because of the efficiencies of, you know, 6 people that are working there when 3 can actually do the job, all of a sudden that $200,000 times 5 is $1 million in value that you can change. So now all of a sudden, because you're more efficient, because you have technology and the right people doing the right jobs, that generates value long term. So ultimately, you have to look through another set of glasses and another set of eyes. And I know it's hard sometimes because you have that loyalty factor, and it doesn't mean that you have to automatically do that tomorrow, but you should do it when people are ready to retire and not replace, right? Get the right people in place over a period of time, and not doesn't have to be this hatchet job that you go through and now you're this person you don't believe you are. You can do it keeping your core values as long as you make intelligent decisions long term and get to a goal, get to a place that you really want to achieve, and that will help you with the right directions, making the right decisions at the right time. Chris?
Yeah, absolutely. That's what I call purposeful business management is, again, to go back to the phrase we used earlier, you're not thinking about hitting your sales target this year or making payroll next week. You're now in the business of building value you're working towards a much larger purposeful goal. And so, yeah, I like the way you said that, Mark. And that's exactly what I was trying to say earlier is to put the clippers away, go slow. Unless you're trying to sell the business in the next year, there's no reason to move that quickly. And you know what? Part of that is if your goal is to build value in the long term, keep that goal in front of you. There will be hard days. This might get a little bit expensive and there's hard decisions to make. But also what I see happen is business owners start seeing, wow, I just look how valuable my business is now, and they get cold feet on their original plan. And hey, that's your prerogative. But if your goal is an exit strategy to build the value of your business and exit, keep that in front of you. Understand you're going to see more profit. You're going to see a much more valuable business, but that's part of your plan. That's your goal. And you don't want to let that positive result divert you from what your exit strategy was, unless obviously it's up to you. But to have other people in your life saying, remember, you're still exiting, right? So that's one of the drawbacks too, is I see small business owners get involved in this process and they get really excited about the results they see and they forget what their purpose is here.
Chris, there's one more point that I'd like to make, and that is that, let's say that you were able to cut certain staff over a period of time because you had a plan and you were able to save $200,000. That doesn't necessarily mean that I have to put that $200,000 in my pocket, right? We can take that $200,000 and redirect it maybe into a new line or expansion or some other means that could give us a better return, because not only did we save $200,000, we now put that $200,000 to work for us, which increases the benefit stream, right? So it's not about just the reduction of costs, but it's then about the growth of the entity. And if you can get your growth up from 2, 3, 4% to 6, 7, 8% by refocusing those dollars, now you got a machine working for you and trying to maximize that value. You've caught cost. The costs were going to be there regardless if you didn't do any changes, right? So you would have the same income without necessarily having the growth. Chris, thoughts?
Yep. You've increased your income and you've also reduced your risk by diversifying your operation.
Exactly.
In the scenario you gave. And so that's a double whammy. And now you have that double whammy times a higher multiple, and now your leverage is working for you big time. And that's the kind of success that we see small business owners see when they start thinking this way rather than meeting next month's payroll.
We just talked a lot about benefits and maximizing the value of your business. I mean, that comes across so many different spectrums, from your personal goals to the sustainability of your business program going forward, to making sure all of your employees can continue on after you're tired and you don't want to do it anymore. Chris, there's so many different benefits. What are the different things you've seen over the years?
Well, and the only thing, you gave a great list right there. I'll add one more, because we could talk about this for another hour, but I'll just add one more, and that is that the morale of your employees will increase. And you kind of referenced that you want to, one of the ways to reduce risk is to have a solid workforce and an employee base that has high morale, that believes in the business, that believes they're part of a strong growing business, will carry over to new owners. And again, ultimately, if that's your goal, is to exit, it makes it an easier exit.
I agree. Our last question that we have here is, why should I try? Everybody kind of goes, everybody does everything. It's easier to sit in the same place every day, doing it over and over and over again. Why should I stir up the apple cart, Chris?
Well, I hope we've conveyed in this session that it's fun. It can be fun. It can be hard, but it really is fun to build something. And if you're kind of bored in your business making payroll, maybe this is a way to start thinking differently about your business and have a little bit of fun along the way. There's also a tremendous payoff. Mark has said this a couple times, and we can't say it enough. $100,000 times 5 is $500,000. And If you can get the multiple up because you're also reducing risk, it goes from 500 to 600,000. And I know that's an oversimplification, but it illustrates the payoff. It's also relatively easy to do for some small businesses. When you start thinking this way and you look around your business, you start to see that, you know what, this isn't unattainable. We're not talking MBA stuff here. We're talking not NBA, but MBA, Master's Business Administration. You don't need an advanced degree to do it, is what I'm trying to say. And it's a challenge, and it's a challenge to develop your vision and then to share your vision and get other people to buy into that vision and then to make it happen. And at the end of the day, the sale of the business is easier and much more lucrative.
If you've enjoyed today's session, please feel free to explore other educational opportunities as presented by Chris or any other member of our national team of experts on PocketExperts.Solutions. Should you have a need for further information on today's topic, or if you require assistance to develop and implement a solution to this and or other related issues affecting you and your business, we suggest you visit with your personal business coach and advisor who can direct you on the next steps. If you do not have a business coach or personal advisor, we invite you to contact Chris through his personal profile information on PocketExperts.Solutions website. As always, we thank you for joining us today and spending your valuable time with us. We look forward to seeing you again soon as you move forward on your journey to achieving your goals.